But one thing I'll say is that inherent in our active philosophy is this idea that we look for value everywhere. And believe it or not, how you run an ETF, whether it be index, and maybe even more so, especially if it's active, it matters a lot.
So our realization there that if we brought the product in tighter and at a tighter creation unit size, it would create optionality for our marketplace to be able to come in, create in a single day and not carry that risk overnight. So they didn't have to charge those additional, what we call inventory management costs. So that gives the opportunity that if you want to come in cash, you can do that as a market maker for a unit.
So each of our ETFs that are active, we are trying to build the factors in which we are most attracted to at this moment. So when you think about a portfolio that you open up, you want to be able to look under the hood and see, hey, how does the portfolio manager think about the world? And that's exactly how we try to build our technology. So when we build our technologies and we get our create baskets, we know exactly where we want to put our money. We know exactly the credits we want to put where that we want to buy through the create process. So in reality, all we're really doing is leveraging technology and taking what our current portfolio management process is, running it through this technology, creating these create baskets to add on to the portfolio. And where that may differ from, say, a passive product is they want to go home at the end of the day knowing that their portfolio looked the same as it was when they walked in the door. Ours is more opportunistic. We are looking for the opportunities in which to go and buy securities that we believe are either the best-in-class type credits, the ones that are the cheapest, or the ones that take the portfolio in the direction in which we're looking to push it.
This really brings us to this next question around, the importance of having a strong active team as well as strong trading capabilities. Jim, maybe can you give us an example about what the process looks like when a basket comes in, how you think about analyzing that? And then on the sort of the other corollary side of that, Dave, like how does that matter when it comes to how well the product trades? So Jim, go ahead.
Sure. And some of the comments I'll make here will echo what you've heard throughout the course of the day. A lot of it starts with thoughtful risk management, then goes into technology, and then comes to the outcomes. So, I would say the typical start of the day, before we even know what creates and redeems are looking like, we want to make sure that what it is we're prepared to do next is updated within our technology. So for example, let's say we believe our outlook is that we think that markets are going to trade sideways. We want to maximize our carry. We're going to build into our technology, our optimization engines, to go to look for securities that will help fit that. Let's say we want to make sure we're putting on additional spread duration. We program that in so that when Dave calls us up a little bit later on in the day and says, hey, XYZ market maker wants to create 20 units of VSDB, we know exactly where we're going to head. We intake that basket. It goes through our optimization engines. The optimization engines are also being assisted by our best ideas from credit research. It's also being assisted by our best RV ideas. It's looking through thousands of lines of inventory, and in about 10 or 15 minutes, it kicks out exactly what we want to do.
The other component of this is product design, where there are probably fewer folks in the industry thinking really deeply about that. We see that in even the share price that some issuers out there have selected, but also how we think about value generation and alpha levers. So, my question, maybe we'll start with you, Dave, is when we talk about high quality fixed income ETFs by design, what are we really trying to solve and what does that mean?
Yeah, I would say it kind of goes into what I was saying with the introduction is it's really that thoughtfulness around your total cost of ownership. We again are famous. We've been the flag bearer for cheap expense ratios for 50 years. But people don't often think about us from the same liquidity lens that they would look at some of our competition. And we think they should. And that's because of some of that product design. I mentioned the creation units earlier. That's something that our team was really active in communicating during the product launches. Share price is another one. It's a hot debate amongst our internal group on where that right level is. But we've chosen $75 for many of these launches because we think it's a really good sweet spot for you to get a low cost to transact with if you have a penny spread on a $75 ETF, you can round to a basis point in spread, where if you have a $25 product, it's going to be 4 basis points of spread every round trip that you take if you rebalance. So we want to find that middle ground. We don't want it to be too expensive, to be thoughtful around low allocations and model portfolios or dividend reinvestment. So we've tried to find that sweet spot, again, to be really thoughtful of what that total cost of ownership is. I mentioned the expectations we try to set for the street. That helps us create really strong premium and really low volatility in our premium discount. And that's a metric that we really care about.
So when we design our active ETFs, we want to make sure that they're going to deliver value at scale. We're going to make sure that they actually fit the ETF market. We're going to make sure, of course, that the capabilities and the value our investment teams can deliver in those products will meet client expectations. All of those are really central to what we put into the design process. Talk to us a little bit about what investors should be focused on when it comes to ETF liquidity, what's important and why.
Yeah, absolutely. So one of the interesting dynamics as it relates to active funds is this weird kind of dichotomy that is basically that what we tend to see clients use active ETFs for is for more passive style strategic investments. You're usually not going to go in and out of an active fund for a tactical strategy. There's a lot of great passive ETFs, many from Vanguard, that are available for you to do that tactical kind of more active play within your portfolio, your client's portfolio, using the passive funds actively, and the active funds tend to be passively. What that ends up meaning a bit for the liquidity spectrum is that it could trade less inherently because there's less of that tactical usage. So all of these things that we're talking about are really in the spirit of where can we add liquidity back into that market.
How do you and the team navigate markets when you're getting creation redemption activity in the midst of volatility in fixed income markets? And what are the key things for clients to understand about the mechanics then?
Sure. So this is where I think ETFs really shine. The ability, especially from an operational perspective, if you want to come in to transact, you do so with your broker dealer. By the time it comes to us, it's how do we choose to put that creation redemption to work? We can use these levers I mentioned a little bit earlier, the flexibility that exists within active management. We can use that process to basically risk up or risk down the fund. We may choose to dial the levers between sector allocation up or down. It just allows us to have more flexibility to continually push the book in the direction in which we want it to be.
I will make the argument, and I've worked the last 12 years in ETF, so I might be a bit biased, but I don't think that there's been any technology or instrument that has entered the fixed income market that has had a greater impact on market structure than the ETF, because it's provided growth in electronic platforms for people thinking about what that risk looks like, if they know the expectation of that risk, as well as portfolio trading. I can point to a trade that occurred on January 21st, 2017 for our intermediate credit product that I believe was kind of the muse to our liquidity provider to think about doing portfolio trades. Now it's a multi-trillion-dollar business. So to see that growth is really important.